Hello, I'm Troy Harmon, Chief Investment Officer with Henssler Financial. I'm here with Nick Antonucci and Jacob Keene, and this is your market update for September 2018. Guys, really not a lot has changed in the month of August, and looking forward into September, we're kind of in the same spot. So we've had the market continue its bull run. We've still got inflation above the Fed's target. Right. Speaking of the Fed, we're still looking at probably 2 more rate hikes in 2018. The employment situation still looks solid. Good gains in employment in August.
201,000 jobs added.
Still 3.9% unemployment. So the employment situation is still absolutely solid. One of the things, we kind of brushed over was the Fed's rate hikes, probabilities, and inflation, and what that has done is given us issues with the yield curve. The 10-year minus the 2-year Treasury yields are at about 23.8 basis points right now, 0.238%, so very flat.
Yeah, and that basically puts us 1 hike away. Which we expect
in September
to get.
A 96% chance of that happening. Yeah. And talking about the Fed and kind of tightening, I think one thing that doesn't get talked about very often is where the Fed is in the unwinding of the balance sheet.
Yeah,
right.
The QT.
We're at $250 billion since it began in October of 2017. Right. Just in the period of August 2nd through September 2nd alone, we had, I think, $25 billion. I'm sorry, 47 billion, 25 in treasuries, 47 total roll off the balance sheet.
And we get into cruise control in October at
full speed ahead, 50 billion a month.
50 billion a month. Troy, you mentioned not much has happened on the domestic front, but if you do look to the international markets, we've seen a lot of craziness. Well, we've seen Turkey have their currency down this year, 40%, Argentina down 50%, and I think some of that is caused by this dollar tightness, this Fed withdrawing the liquidity to the foreign market. And at the same time, we saw today Trump's coming out with additional tariffs. So I think last year we had, call it $505 billion in imports from China.
Right.
So with this 267 plus the 200 plus the original 50, that put us at 517. That'd basically be a tariff on everything
that we import from China. Yeah, and that really is having an impact, not just on China, but also developed nations throughout the international.
If you think about what's kind of driven U.S. markets the days that we have had down, it hasn't been domestic problems, as you mentioned. The picture here looks bright.
Right.
It's always headlines out of China or trade issues, or as you mentioned, Turkey and European exposure to Turkish bonds, things of that nature, that has really driven U.S. markets lower over the past month.
Yeah. You guys said 96% probability of a rate hike in late September. Obviously, we expect that, but we're also seeing probabilities over 60%, really almost to 70% for a fourth rate hike for 2018. In December.
Right.
So, that picture, Jacob, you said it, looks like we're about 1 hike away from an inverted yield curve. When we've seen those historically, usually within 6 to 18 months, you start seeing recessionary pressures. Recession obviously defined by back-to-back quarters of negative GDP growth. So, that's kind of where we are. We're really on high alert, I would say, but don't get that wrong. We're still saying stay invested in equities. At the moment, we haven't seen any of those triggers that we watch so closely give us an indication that we should start ringing the bell.
I mean, the equity market's still strong. You've got the NASDAQ just touching a new all-time high. The S&P 500 is up almost 9% for the year on a total return basis.
Yeah, I've kind of brushed over it too.
Continuing to see consumer discretionary technology stocks lead the way. They're the leaders year to date. They're the leaders in August.
Yeah, longest bull market in history now is currently what we're in. Previously, from October of 90 through March of 2000, was the previous longest ever bull market, 3,452 days. We're about a little better than 2 weeks past that at this time. And like I said, we got new all-time highs in the last couple of weeks of August for the S&P 500, finally getting past that that high that we hit at the end of January in 2018. 8.85% higher on the S&P 500, 18% in technology, or no, 18% in consumer discretionaries, 17.75% in technology. But the thing is, those have been very concentrated. The drivers are about 2 stocks in each of those sectors. With consumer discretionary, it's Amazon and Netflix that have driven that sector higher. 65% of the overall gains year to date can be attributed to those 2 stocks.
In that sector.
Yeah, in consumer discretionaries. And then you look at information technology, and really, I was kind of surprised to see this, but it's Apple and Microsoft that make up about 45% of the overall gain in that one sector year to date. So very interesting things to watch. Economically, everything seems solid.
Yeah, there's some quick hits there. We saw wage growth actually hit 2.9.
Right, yeah.
Just recently,
as well.
Productivity was right there at 2.9.
Yeah.
Solid. PMIs look great,
Right.
at cycle high. So, I mean, there's nothing to say this market's about to roll over.
The
New
consumer
highs.
still looks strong, too.
I think our biggest concern is valuations.
Absolutely, yeah.
But, I mean, a market doesn't reverse just because of valuations. We're going to have to see some slowing down in the economy, and we haven't seen it yet.
No sign of it domestically at this point. All right, well, that's been your market update for September 2018 from Henssler Financial. We thank you for watching.